What is the spread? When trading Forex, dealers always quote you two prices, the bid and the ask. The bid is what you can sell a pair for, while the ask is what you can buy it for. The ask is generally higher than the bid. So, just remember, you buy at the higher price and sell at the lower price. The difference between the bid and ask is known as the spread. Essentially, the spread is the cost to trade a pair. Market liquidity can often have a significant effect on the spread. In Forex, liquidity refers to a currency pair's ability to be traded at any given time. During times of high liquidity, spreads tend to be narrower, whereas when liquidity is low, spreads are usually wider. The size of a trade can also affect the spread. Generally, larger trade sizes lead to wider spreads. Spreads can also widen during volatile market conditions. As an example, let's compare US dollar Canadian dollar to US dollar South African rand. As a major currency pair, trading volumes on US dollar Canadian dollar are high, leading to spreads as low as 1.2 pips, or 0.00012. US dollar South African rand, however, is an exotic pair with low volumes, where spreads can reach as high as 100 pips. But how do spreads relate to transaction costs? Say you want to trade 10,000 units of US dollar Canadian dollar at a rate of 1.41065. You calculate that the pip for this trade will be 70 cents. Assuming the spread on the pair was 1.2 pips, your transaction cost would be 84 cents. How does US dollar South African rand compare? If you were to trade 10,000 units at a rate of 17.14165, each pip would be worth 6 cents. But with a spread of 100 pips, your transaction cost for this trade would be $6. That's more than 7 times the amount of the US dollar Canadian dollar trade. It's always important to know how much a trade is going to cost before you place it, as this can affect both your strategy and potential for profit or loss. To learn more about Forex, visit trading.com.